Hello guys, today we are going to learn about the accounting equation. I will explain each and every element in the equation and also we will move on to examples. So, what is the accounting equation? The basic accounting equation goes as assets equal capital plus liabilities. An alternative name for capital will be equity. You can use either one of them. What are assets? Let's first learn what assets are. So this is how you define assets. Assets are resources controlled by the business and these will lead to future economic benefits. What is that supposed to mean? Resources controlled by the business. For example, the cash held within the business. The cash that the business has is under the business's control. Another example would be the motor vehicle used for delivery purposes in the business. So that is also something that's under the business's control. Likewise, we can also take buildings, the factory building, which is controlled by that business. Right? So those are resources controlled by the business. So first part of the equation, first part of the definition is complete. Leads to future economic benefits. To explain that part, I would move on to another example. You might have come across the term debtors or trade receivables or even accounts receivables. Let's see what that means first. So trade receivables or debtors are people who owes the business money. What is that supposed to mean? Let's say I am business A and I manufacture chocolate. But I'm not the person who is selling these chocolates to the public. It's another company. Another outlet is selling. Outlet B is only selling it to the end consumer. So what happens here is business B will buy the chocolates I produce in bulk. But business B won't pay me as and when he buys. He would say, okay, I will buy your chocolates today, but I won't pay now itself. I will pay within the next month. So I didn't get my money yet, but in the future I will get it. Right? So that makes it bring future economic benefits, which is why you categorize debtors or trade receivables as assets because it leads to future economic benefits. Another example for assets would be inventory or stocks. In that case, in this example, it will be the chocolates that I produce, business A. So the chocolates I produce, those are my stocks, right? So those are resources that are under my control. And that satisfies this part of the equation. Let's go to the next part. Now those stocks, the inventory, the chocolates, I can sell it and earn money. Having the stocks and selling them in the future will lead to future economic benefits. So that satisfies the next part. That is about assets. Let's see what capital means. Okay, capital is the owner's equity. Let's say that the owner of the business invests money. So the owner gives money for the business's use. That is capital, right? And if the owner gives a motor vehicle for the business, that also becomes capital. So basically, whatever that the owner contributes, the owner's contribution, I will change this, the owner's contribution basically is capital. Then what are liabilities? Right, liabilities are obligations. So what the business owes to the third party. And these will lead to future economic outflows. Obligations means that the business will have to pay something someday, right? Basically, the business owes money to someone. And paying them might lead to a future economic outflow. The best example for this is a bank loan. So let's say the business borrows money from the bank. The business will have to pay the bank that particular amount one day. The business will have to repay it, which means that the business owes money to the bank. So in another few years, the business will repay the bank, which means it will lead to a future economic outflow. That's one example. Let's go to another example. This is basically the opposite of debtors, that is creditors. Creditors, accounts payables, or you can even call them trade payables. So let's say, okay, I am manufacturing chocolate, right? The same example. I'm business A. But to manufacture chocolate, I need ingredients, right? So I might, let's take cocoa. I have to get cocoa from another supplier. Let's say supplier X. So supplier X, I buy cocoa from supplier X, but I won't pay right at that moment. I would say, okay, I will buy the cocoa right now, but I will pay within another month, within the next month. That means I owe my supplier X. So that makes X my creditor. And in the future, when I pay him, that's an outflow, a future economic outflow.